Welcome back to my channel. So today's video, I'll cover 7 different elements and factors that typically are not discussed with new traders before they begin options trading or day trading. So I want to provide this list so if you are new, this will help you at least have an advantage in the market because I'm discussing things that most people are not going to tell you. These are going to be the actual hard facts that you may not know before you begin your trading journey. Okay, so the first topic that I want to discuss is that most people may be unaware, but a lot of contracts, the majority of them at least, do not expire with any value. And you may not know that if you just started trading. And what I mean by that is typically the majority of contracts that you're looking at on the option chain, depending on the strike price, whatever it is, good majority of those will actually expire out the money. Which means because they expire out the money, there's no intrinsic value in the contract. Now, does this mean that you're going to lose money every single time you trade? No. That's the whole point in buying and selling your option contracts before it gets to the expiration date. So when you see someone trading 0 DTE, they're literally fighting against the clock, right? But of course, if you're trading and you're doing like swings, or even if you're day trading, your whole point in selling your contract before it gets to the point where it's worthless, you want to have that intrinsic value within it before the contract expires out the money. But if we're statistically speaking, so your point in options trading is to be able to retain the value in your contract, you got to beat that expiration date. And that's why you'll notice a lot of people sell before it even gets close to it because they don't want to compete with the theta at all because that's a losing battle regardless. Okay, so that's the first thing. Okay, so the second factor I want to discuss is that implied volatility can actually matter more than the directional move itself. Now, I know that may sound crazy if you're brand new because you've been told that it's all about the directional move. If it's a rally, then you're looking obviously to buy. Essentially, if it's a sell-off, that's the drawdown, you're looking at playing for puts, right? That's typically what new traders are told. But you may not be aware of the fact that implied volatility plays a major factor in the directional move before the move happens. Okay, that's something that's not always discussed. We hear it all the time, but it's not always discussed in detail. So basically, to put this simply, that a trader can know the directional move and be correct about it, but if the implied volatility collapses, they can still lose money after the event. So it could be anything that can cause it to collapse, and that's known as the IV crush. Oftentimes, new traders are not aware of this. Now, events can take place. It could be like FOMC news. It could be earnings. You guys know it's earnings season. So it could be anything that can cause any sort of directional change without you really realizing it's going to affect the market that deeply. And that can cause the IV crush. And then essentially what happens is a lot of traders are unaware of it and they may lose money. Okay, so to provide an example for this, let's say you got into a play for a stock or ETF. Let's say it's going your direction and you're winning the trade. And then of course you're making money. Let's say it's a swing trade. But let's say that company reports earnings while you still have that open position and it's negative. The implied volatility can essentially collapse and have that option premium fall, and now you have to face the consequence of that. So basically what I'm saying is that if the IV crush takes place in the middle of you being in that position, it can have a negative impact on the actual dollar value you walk away with for your P&L. So be very cautious about how you choose to cycle in your plays, especially if they're swing trades. Okay, so the third factor that a lot of new traders may be unaware of is the fact that you are fighting against algorithms. There's a ton of algorithmic trading taking place in the market, and oftentimes if you don't understand how it works and how these algos are set up, you can definitely end up on the losing side of things because you may not be aware of how to pivot when large institutional plays take place. Now keep in mind, a large portion of market volume is generated by high frequency trading firms, which means it's not a real person placing a trade the way you or I would. It's an actual system behind it. So if you're one to believe that you're trading in the market with other people, the majority of time when you see large sums of money being moved, it is not a manual trade. That is being placed by an institution, a firm, agency, whatever. Those are going to be trades that are going to be signaled, and they have nothing to do with the person clicking a button. That's going to be all algorithmic trading taking place. Now, as a result of this is when you'll see automated liquidity placed in the market, which can make trading a little difficult if you're a beginner and you don't know the signs to look for. Now, I can make a whole detailed video about this because it can be kind of long-winded, but I can go into more detail if you guys want me to make a separate video talking about this, and then also showing you guys the volume profile. Oftentimes we see volume at the bottom of our charts and it's vertical, but I want y'all to know that you can see volume from a horizontal standpoint and see patterns within it as well. So again, if y'all want me to make a video about that, just feel free to let me know. Okay, so the fourth factor on this list is going to be the fact that delta changes dynamically. It is not a set or fixed price. And that goes for all the option Greeks. None of them are going to be set in stone and fixed. So you'll often see when the market is closed, the numbers even jump even after hours. Now the changes won't be as frequent as you would see when the market is actually open, but again, these are not fixed numbers. Now, specifically, if we're talking about the delta, some may think that it is a static number. However, in reality, the delta will accelerate or weaken depending upon the stock price changes. And that's what you'll see tag along, which is known as the gamma, because essentially that's the rate of change of the delta. So I always tell my clients that the delta is going to be like big brother, the gamma is like the little brother. It tags along. So if the big brother is like, I'm going to the mall, the little brother is raising their hand like, I want to go too. It tags along, it goes everywhere. Now, in addition to that, gamma actually accelerates very, very quickly once we get closer and closer to 0 DTE becoming a factor. Because in reality, that's when you notice that gamma becomes more and more aggressive as well. So keep that in mind. Now, the fifth element to this that may not be discussed as often, and new traders may not be aware of it, is going to be the fact that liquidity oftentimes matters more than the chart setup itself as well. So y'all heard me talk about implied volatility, but now this is a point to understand liquidity can also play a major factor, and sometimes in some cases it's more important than the setup itself, because you can have a perfect setup, but if there's no liquidity backing it, then it kind of becomes an aimless play. So just to put it plain and simple, you could have the perfect setup, everything could align, you got all the indications you need, you feel like it's high probability. However, if it's on an illiquid option contract, then you'll likely see that it's going to be a poor result. And that could be everything from poor fills, wide spreads, slippage, all that could take place. Any of those options, and it could be a combination of them as well. So think about it like this. You can have two people enter a trade at the same time trading the same stock. But if one person chose to trade in a liquid contract and the other person chose one that has a ton of liquidity, the person that chose the one that has the liquidity is often going to be able to get in the trade, out of the trade with no issues and problems because the spread is tighter. So they don't have to face the fact that there may be poor fills. So essentially what that means is that they have the advantage in the fact that they're trading a contract that can produce the result they're actually looking for. Versus the person who did it may have to rely on hope. And you never want to trade off hope, y'all. I've told y'all that before. That's not the idea. That's not the direction you want to go in. Alright, so the next thing on the list is going to be the simple fact that many institutions use option contracts as protection, not speculation. Now, what I mean by this is oftentimes as new traders or investors, you may be using your option contracts as leverage, but institutions are actually using it for defensive protection on their portfolios. That's a major difference in how you can play the game. And what that essentially means is a large number of these institutional trades are protecting their downside risk. They're hedging their portfolio, they're reducing their tax exposure, and of course they're understanding how implied volatility plays a major part in the long-term game. So again, that's completely different from a regular person just placing an options trade. They have a whole different strategy on how they go about it. So again, keep in mind that some option activity is really just their insurance. That's how they basically cover what they need on the back end. It's totally different on how a regular standard person would trade. And if you're brand new, this may catch you off guard to know that information. Okay, so the last factor I want to mention in this video is the fact that time decay is non-linear as well. And with that being said, theta is not evenly distributed. I want to stress this point because if you're a new trader, it goes without saying that option contracts lose value every single day. There's no way anyone can get around that. But be very clear that this acceleration will speed up closer and closer to that 0 DTE as mentioned. And the reason I'm stressing this is because new traders get into it thinking that, okay, this is a fixed number. It is not. The number is not static. It's going to continue to grow, and again, it gets more and more accelerated the closer it gets to that option expiring. Now, I already kind of mentioned the fact that most contracts don't expire in the money anyway, so you definitely want to make sure that your strategy incorporates the fact that you need to get out of the trade before you lose any money and that contract doesn't hold any value. Because there can be rapid decay even with minimal stock movement. That can be surprising for a lot of new traders to know as well, so I definitely want to make sure y'all are aware of that. Now, of course, y'all know I always do my one-on-one, so if you need these conceptual things broken down on a more basic level, feel free to hit the link down below in the description box. Essentially, that is going to be everything we have for today's video. Y'all already know I appreciate y'all so much for watching, And of course, I'll see y'all in my next one.